Right now, Snap Inc. is in the fight of its life. Seriously, you've got this company caught between the absolute giants of tech and these scrappy little startups, and they're making a massive bet on a whole new strategy. The big question is, will it actually save them? Or is this just a final, desperate roll of the dice? Let's break it all down.
So this is really the heart of the matter. What we're asking is this big pivot to making money a genuine, brilliant turnaround? Or is it a move that's going to alienate their core users and basically seal their fate? This goes way beyond the numbers on a spreadsheet. We're talking about a comeback story versus a collapse. And you don't even have to take my word for it. Those are the words from the CEO himself. A crucible moment. That's a trial by fire. It means one of two things is going to happen. Either Snap comes out of this stronger and tougher than ever, or it completely shatters under all this pressure.
Okay, so here's our game plan. We're going to look at Snap's biggest strengths versus its biggest threats, then we'll crunch the numbers that actually matter, check out its valuation, and of course, deliver our final verdict.
Any investment really just boils down to this simple idea: a company's competitive advantage, what we call its moat, up against all the risks that are trying to tear that moat down. So let's dive in and see how strong Snap's defenses really are.
So on one side, you have the bull case, right? Snap absolutely dominates the youth market. They're a leader in augmented reality, and they're in this kind of unique sweet spot, big enough to play with the big dogs, but nimble enough to move fast. But then the bear case is just as compelling. Brutal competition, scary regulations on the horizon, and the big one, user engagement that's starting to drop. Let's drill down on those threats for a second. You've got the nonstop pressure from Meta's Reels and YouTube Shorts. Then you've got this regulatory hammer just waiting to fall with things like the Kids Online Safety Act that could totally change the app. But honestly, the biggest red flag, for the first time ever, their daily active users are actually falling. They lost 4 million in North America alone. That's their most valuable market. Ouch!
But hang on. User numbers, that's only half the picture. The real question is whether the financials can tell a different story. So let's get into the numbers and see if this turnaround is really happening.
All right, first up, revenue growth. The easiest way to think about this is like checking a company's pulse. Is it strong and steady? That means it's healthy and growing. If it's weak or slowing down, well, that could mean trouble.
And what's interesting here is that Snap's pulse is surprisingly strong. Revenue is up 10% year over year. Now this is so important because even with user growth stalling, they're clearly getting much better at making money from the users they already have.
Next up, gross margin. This is a fantastic little metric for figuring out how efficient a company is. Basically, it's the profit a company makes on every single dollar of sales before you factor in all the other operating costs. The higher that margin, the more profitable the actual business is at its core.
And would you look at that? Snap's gross margin is a stellar 59%. Now, this isn't just some random number. It's cold, hard proof that their new strategy, shifting to things like Snapchat Plus subscriptions, is working exactly like they planned.
Okay, so now we have to talk about risk, the debt-to-equity ratio. It's kind of like looking at a company's credit card bill. It tells you how much of their business is being funded with borrowed money versus their own cash. And a high number here can definitely be a warning sign.
Snap's ratio is sitting at 1.87. Now, that does suggest they're relying pretty heavily on debt. And while that's not always a bad thing, that level of debt adds another layer of risk, especially if things in the market get a little tougher. It's for sure something to keep a close eye on.
And finally, we get to my favorite metric, free cash flow. I just love it because, well, you can't fake cash. It's the actual cold, hard money that's left over after all the essential bills are paid. To me, it's the ultimate test of a company's real financial strength.
And right here, this is the single most compelling piece of evidence for anyone bullish on Snap. Their free cash flow has almost tripled in just 1 year. It's skyrocketed from $147 million to $414 million. That is a massive win for their new strategy.
So we're left with this kind of paradox, right? The financials are looking really good, but the user base is actually shrinking. So what on earth does that mean for what the stock is actually worth?
Well, if we look at the price-to-sales ratio, which is just a really simple way to value a company, Snap is trading at 1.71. That is near a 10-year low for the stock. What that's basically telling you is that the market thinks a dollar of Snap's sales is worth less today than it's been in a very long time.
And it seems Wall Street analysts agree that there could be some room to grow. The average price target from the experts covering the stock is $9.82. That consensus gives us a pretty solid benchmark for where they see this thing heading over the next year.
But, and this is a big but, there is one massive risk out there that could just derail this entire story: regulation. We're talking about laws that could force them to completely change how the app works and how they sell ads, hitting them right where it hurts the most, that core young user base.
Okay, so we've seen the strong financials, we've seen the user problems, and we've seen the regulatory storm brewing on the horizon. It's time to put it all together and make the call.
So here it is. Our final verdict on Snap is a hold, with a 12-month price target of $9.82. Look, their pivot to profitability is genuinely impressive, but the risks, they are just too big to ignore for us to give this a full-throated buy right now.
And it really just all comes down to this. The whole bull case is built on this incredible financial performance. We're talking positive net income, great margins, and that explosive cash flow. But the bear case points to a huge crack in that foundation, a shrinking user base where it matters most, which could potentially bring the whole thing crashing down.
Now, for any investors out there who are just not comfortable with that level of risk, the sources we looked at point to a couple of alternatives. First, you got Meta, which is already cashing in on short-form video with Reels. Second, there's Alphabet, a much more diversified and stable tech giant that's pretty well insulated from the specific problems Snap is facing.
And all of that leaves us with this one final question. Snap is making a huge bet that being profitable is more important than just growing your user count. In the absolutely brutal world of the social media wars, is that a strategy to win? Or is it just a strategy to survive? We'd really love to hear what you think down in the comments.